So a catastrophe bond is essentially like an insurance policy, but instead of being placed with insurers, it's placed with the capital markets. So the capital markets investors who are buying the bonds are receiving a coupon that reflects an insurance premium. And if an event occurs, as defined in the terms of the bond, there's a loss on the bond, and the insured party, in this case, the Philippines, will receive the money, and the investors will suffer the loss.
How popular are they?
It's a market that's existed since the early 1990s. It started in the U.S. after Hurricane Andrew devastated the insurance market in Florida, and insurers realized they needed additional sources of capacity beyond the traditional reinsurance market. It's a market that's about $30 billion US right now. We've had issuances last year, new issuance of about $9 billion. So not a huge market, but a significant part of global reinsurance.
Stephen?
Looking at it from an investor's perspective, and because of climate change, obviously these must be viewed as being very high risk. So how does the coupon compare with, let's say, a standard sovereign, perhaps?
Well, the coupon is essentially a combination of a funding cost, because investors are obviously putting up their money, plus a risk premium, which is essentially the insurance premium that the sponsor is paying. So, of course, that premium is based on the degree of risk they're taking. So basically, you work it from an insurance model, and you base the model. The model will tell you what's the expected loss on the transaction, and that becomes the basis of the coupon the investors expect. But as you say, it's a relatively complex market, and so you're talking about a fairly sophisticated group of investors. There's maybe only 50 or 60 really active investors in this market around the world who understand the modeling.
So this would, by and large, be sort of institutional investors, maybe
it's entirely institutional, because it's just too complex, and there's always a risk of loss. So we wouldn't want to place any of these bonds with retail. Yeah,
understood. Okay, so let's take, for example, the new Philippine paper just out. What kind of coupon are we talking about, and what is the tenure, the maturity like?
So it's a 3-year transaction. It's in 2 tranches. One covers earthquake and one covers tropical cyclones, for a total of $225 million. And the coupon is a floating rate coupon, so their investors are getting a 3-month US dollar LIBOR plus a risk margin, which is essentially the insurance premium, which is about 550 basis points on each tranche.
Which goes up and down by season, by weather?
It's set for the life of the transaction. So for 3 years, that's what they'll receive, unless, of course, the transaction terminates early. If there's a significant enough tropical cyclone or earthquake to cause early termination, of course, then the transaction will terminate. The money will go to the Philippines, and the investors will be out.
Does it sound attractive to you as an investor?
Well, I was just thinking 550 basis points over US LIBOR, given the frequency of cyclones and earthquakes, it wouldn't sound particularly attractive.
Well, you can compare it, on an expected loss basis, you can compare it to the credit markets, right? Yeah. And if you look at a credit expected loss versus a insurance-linked securities expected loss, I think you'll find that actually it's a fairly attractive coupon for investors who understand the risk. So, obviously, if you don't have an insurance modeling capability, then you're just taking a punt on it, and that's a fairly significant risk. But for those investors who have the specialization, I think it can be a very attractive asset class.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.